Coming up today, stocks fall across the board. Bill Ackman gets into Uber. A look at AI spending, the latest jobs report, and everything else to get you updated going into Super Bowl weekend. It's going to be a great one, guys. Let's go. And welcome back to Click Capital, everybody. Bit of a red day to finish the week off on the back of some macro news I'll get into later. Bit of a continuation of that trend we've been seeing lately. Mega cap tech coming under pressure here. All bar Meta, NVDA today. Some of the biggest names in the market experiencing some selling here today. Looking across the rest of the market was quite checkered. Even though all sectors finished in the red, we did see a few spots of green throughout. And just switching over the heat map to the weekly performance. Now that we just wrapped up the week, got a nice bounce back from NVIDIA this week, up 8%. Meta's still the strongest out of all the mega cap tech. But once again, we can see Alphabet, Tesla, Amazon, Apple, and Microsoft having a bit of a pullback this week on the back of their earnings, for which they by and large came in with good numbers, a little shy of some estimates and guidance, but otherwise still showing healthy growth. And so was this just an earnings shakeout, or is this potentially the start of a nasty trade war with China in which they're used as pawns? And so we'll take a look at a couple of those stocks, a few more other things. And since it's the end of the week, I thought I'd do something a little different today with the charts and use my simple chart layout, go through all key markets for you today. And so today we'll just remove the candles indicators so we can focus clearly on the trends and perform some simple technical analysis on multiple time frames. After watching this video, you'll have a great understanding of all the trends in key markets and a better feel for where markets are at this point in time. So just looking at the S&P 500 here, we have been consolidating pretty much ever since the election, just been bunching up here. As I'd say, that's largely to do with tariffs. Markets finding it hard to get real excited and run away until they really know what we're working with, especially when it comes to China. Did see some reprieve with Canada and Mexico earlier on, good signs. And there's a look at the NASDAQ. And just to let you know what you're looking at here on the chart, it's obviously an area chart using the closing prices. So we don't see those intraday highs and lows. And it's a 50-day simple moving average. Always like to use the 50-day. I found in my experience, a lot of institutions, floor traders and so on, they quite often use a 50-day average to kind of gauge a short-term fair value for markets here. Again, Russell 2000 had already been consolidating going into the election. Did get that nice pop-up and excitement. Bit of a sharp pullback in December. Again, just consolidating. But if we go out to the weekly chart here, still looks constructive to my eye. Higher highs, higher lows, still uptrending, not too extended above the 50-week moving average because we're on a weekly chart. The orange line converts over to a 50-week. And just looking over at the VIX volatility index, relatively low, 16.2, given the global macro setup. Still early days and a potential long trade war, which can have big implications for markets in terms of inflation, consumer spending. However, volatility seems relatively calm compared to the few months we had after that 5th of August spike. You can see it kind of opened up the volatility market for some bigger swings. We got that other spike in December, then it's kind of calmed down somewhat here. And just looking at the 2-year government bond yield, that's actually looking a little bit bullish there, isn't it? Maybe consolidating somewhat before breaking out higher. And so that could be a little bit of a headwind on equities here in the short term. And if we do break out on yields, obviously that won't be good for bonds either. Still got TLT and a bit of a persistent short-term downtrend here. And there's a look at Bitcoin, also consolidating, maybe a potential distribution here. Still waiting for confirmation of an official strategic national reserve. And just going out to a weekly chart, are a little stretched on the weekly there, but of course nothing like the monthly chart. So there is a strong consensus that Bitcoin should rip again this year. I guess it's all related to risk markets and growth. And so like a lot of markets are kind of consolidating, kind of in the middle ground here. The bottom of this range, at least on a closing basis, is around 92,500. Got the top there at 106,500. And so investors are still on edge. We can see that with the AAPL investment sentiment survey. Bearishness among individual investors is sitting at a yearly high. A lot of people are worried about tariffs. The markets have been on a good run for over 2 years. Uncertainty over Trump's policies, bit of contracting growth in Europe. There are always plenty of reasons to be worried. But who's not worried is one of the greatest investors ever, Bill Ackman, and his hedge fund Pershing Square, building a sizable $2.3 billion stake in Uber, which he posted about on his X account today. So he's been acquiring shares since early January this year. Did acknowledge they did have some prior issues with management. Now the new CEO's turned it into a highly profitable and cash generative growth machine. We believe that Uber is one of the best managed and highest quality businesses in the world. Remarkably, it can still be purchased at a massive discount to its intrinsic value. This favorable combination of attributes is extremely rare, particularly for a large cap company. And so as my regular viewers know, that's something I've been talking about for a little while with Uber and why I got into it last year. And I've been adding to my position as well. And the market may be starting to wake up to this. Judging by this explosive volume move we got again today, up another 6.5% after it did fall after earnings initially. But like I said on that day, the numbers were still good. The market can sometimes do that shakeout and just give a negative reaction for whatever reason. I think a lot of algos in the market just look for investor positioning and can use any news, good or bad, to kind of slam the tape and try and shake out weekends. that's why you got to know what you're investing in. If you understand what you've got, you can take advantage of prices instead of just being shaken out by them. And just zooming out to the weekly chart on Uber, we've rallied up, and again, like a lot of assets, consolidated for pretty much a year here. I think there might be a good chance this could prove to be a consolidation in the trend. We may just break out again above 88 this year. But it's reassuring to see Bill Ackman, like I said, billionaire hedge fund investor with one of the best long-term track records, speaking favorably of this stock and getting into it in a material way. Uber CEO also responded to Bill today, said thanks for making a bet on us and super excited to have you on board as a shareholder, mentioning Bill's a power consumer of the product, quite often called him to give his feedback. And just looking at my tip ranks account here, a summary was really positive. Like I told you guys on the day, huge growth, 21% year over year in gross bookings. That's amazing considering how big and dominant they already are. Uber One membership added 5 million new members to its Uber One program in Q4. I was actually one of them myself, as I regularly use Uber Eats to get food delivered. Just pay a small yearly fee and you can get free delivery. It's a pretty good deal. And they've really improved the business over the last couple of years. Not only in revenue growth, like we can see in the blue bars here, but also in their profit margin in the orange line. A lot less volatility, more stable and growing. And the balance sheet is also stable as well, getting debt to assets downtrending there. And there's a look at the monthly chart. And for a big dominant tech company, it's a global platform, really good business qualities, really scalable, kind of really languished behind the market, as it's already been on the market for over 5.5 years now. Market cap 157 billion. I think this is destined to be another $1 trillion company, and I plan on staying long until it does. And so the big theme, especially coming into the market last Monday morning on that DeepSeek freakout, massive gap down, which it was bought just like this Monday morning on the back of tariff fears, China biting back. The narrative the bears were pushing is because of DeepSeek and their ability to pretty much create a ChatGPT clone for apparently a fraction of the cost and a fraction of the GPUs, for which they have proven some good efficiency. However, there's also other signs they did actually receive funding in the billions of dollars. They did actually get their hands on some NVIDIA H100 chips for the training, and they may have actually trained their model directly on ChatGPT. Surprise, surprise, right? However, the narrative the bears were saying is this is really going to topple CapEx. Big theme running through the market. All these hyperscalers spending billions and billions of dollars to build out their AI infrastructure in an arms race. However, I'd say that narrative is pretty much already fallen over flat on its face. We just heard all the big mega cap tech not only reiterate their CapEx, but in a few cases increase them. Alphabet, 95 billion. Amazon wants to spend 100 billion this year in CapEx. And by some estimates, over the next 3 years, total CapEx could be in excess of 2 trillion. And a lot of that money is bound to find its way into NVIDIA's coffers. There's a look at Amazon, for example. Big increase last year, and they don't plan on slowing down. And what's really going to accelerate this is the move into robotics as well. Tesla building out massive GPU cluster farms. There's going to be a huge need for compute power, electricity, and sure, we'll have our bumps in the road, but unless we get a full-blown recession, it should just remain that, bumps in the road. And even if DeepSeek does show we can do more with less, that's great for scalability. AI usage is going to skyrocket, but these companies are still going to spend big if they can, especially if the market allows them. And so this was already a secular trend. Data center construction, you could kind of think of the big technology booms, as in the 90s was PCs and the internet. In the 2000s, we went into smartphones. The 2010s was the move from physical to digital cloud. And I'd say the 2020s is AI and robotics, with robotics still being very early days, and that may actually come more into play later on this decade into the 2030s. But just in the last 3 years, we've seen 42% compounded annual growth in the value of private construction for data centers. And so at the forefront of that is NVIDIA, which has actually been consolidating for over half a year now, kind of been bouncing around all the way down to 99, all the way up to 149. So to have a good bounce back this week. And that's kind of been the trend in the chip sector at large. There's SMH really consolidating here. Could be setting up for a big move either way. Did see a little bit more weakness in AMD today. Still trying to find a bottom down here. But some others are performing better, like Broadcom, really holding on to that earnings gain. Another one trying to find a bottom, ASML, key part of the chip supply chain. Another one that looks like I'm going to get the stock put in my account, Intel. See whether this can turn around in 2025 and whether Taiwan Semi also gets used as a bit of a political football from both sides. Both Trump and Xi could come after this company. But looking a little bit better, the Global Robotics and Automation Index, ETF, Robo, a few weeks ago that actually broke out of yearly highs, just pulling back here and consolidating. And like I said, these companies could really be the beneficiary of cheaper AI. But interesting to see what has been performing really well straight out the gate this year. And once again, the market does quite the opposite of what a lot of people expect. Sometimes it can be a good idea to go the other way of your first thought on something, because a lot of the time, our natural reflexes in the market can be wrong. Just looking at FXI China large cap ETF here, holding up after that explosive move in late September on news news of their first massive stimulus. No doubt the tariff worries been keeping this thing consolidating as well. However, we are getting some constructive price action here and in some key names as well. Massive bounce for Alibaba the last few weeks. This thing's absolutely ripped off lows here. And Tiger Brokers shaping up on the chart as well. Maybe just starting to come out of consolidation. We get a nice clean break above $8 a share. That'll be looking good. And again, that's why I say Chinese securities can make for great diversification. Once again, American indices down across the board today. Chinese securities, pretty much all of them up. And like I said, if we do get a deal with China, whenever that comes, that could clear the path for a monster rally in some of these names for the rest of the year. But just moving on from that to the other big news we got today, jobs report. Did come in a little soft on the number of new jobs, 143,000, but unemployment rate did actually slip to 4%. We were expecting 4.1. So it's a little bit of the down up reading. And that can basically just mean there's less employable people in the market. And we are getting some bearish headlines off that print. This one today, the slowdown in payrolls is the first shoe to drop in downward direction for the economy. With the analysts pointing at tariffs, saying it's ridiculous to think that they're going to be neutral for the economy. But just looking at a 1 year chart of the non-farm payrolls, they bump around quite a lot of noise in the short term. That's why we use moving averages to smooth out the trends. I remember in October, a lot of people freaked out because it came in 44,000. However, the reading we just got actually came in higher than half of all the prints we got last year. 1, 2, 3, 4, 5, 6. And just going out to a 3 year chart, it was higher than this month, the same time last year, 119,000, Jan 24. And those big prints we got in 22, 23, that was the recovery after COVID. Blew economic numbers out all over the place. So it's clearly stabilized, and you could say over the last almost 2 years, we're pretty much flatlining here. And in fact, that read we got last month was actually a 2 year breakout, 307,000. So long story short, I think it's too early to start sounding alarm bells on the jobs market. It still is growing. Unemployment rate's really low. And of course, there's always risks. But for the here and now, it's still somewhat solid. But consumers are worried. How much are tariffs going to bite them on their food bills? The States imports a lot of fruit. Some things could get more expensive. If this 30-day hold with Mexico doesn't work out, going to see the price of avocados go up a lot. But that just means consumers will buy less avocados and they'll buy more of some other fruit that's domestically produced. Nonetheless, consumers' expectations are a little worried here on inflation, and that did have a bit of a tick up here today. Looking at the Michigan survey, had been in a pretty steep downtrend here, and it's going out to a long 10-year chart, like we've been saying of late. Maybe inflation's finding somewhat of a bottom, and if consumers are expecting that, they're probably already feeling that a little bit. And there's a look at Fed Fund futures, what traders are expecting path of interest rates to be forward is. Now got about a 50-50 chance the Fed's going to cut in May, but the market only pricing in one more cut this year, and that's a big if and maybe. Really could go either way here. Markets are almost back flat neutral, pricing the Fed hasn't been done. And like I said, government bond yields were up across the board today. The market was really worried about the jobs market. That would imply weakness in the economy and the Fed would have to lower rates. The bond market would react to that by buying bonds. They didn't. Yields went up, suggesting the market thinks jobs is okay, but what about inflation? On the back of consumers saying they're feeling it. And we can see that in the spread of inflation-protected securities versus treasuries. Still in this uptrend, still sitting at yearly highs. But looking at a similar spread of inflation expectations, commodities versus long-dated treasuries, still somewhat consolidating here. We have done for a while. I'll just go out to a weekly chart on this spread. So you can see there the market really pricing in inflation. Saw it all the way back in late 20 before it really took off in 22. That's when yields shot up and bonds absolutely collapsed. Now it's pretty much been consolidating ever since the Fed stopped hiking. But if inflation is going to materially uptick on the upside, the spread's going to break out. And again, commodities will be one of the best places to hide. But the market's already onto that. Gold's already been on a real strong run for a few months, maybe getting a little stretched. If we just go out to the monthly chart, 50-month average 2031, here we are 2886. If we just go back to the last peak and we'll measure how far above gold topped out above its 50-month average back in 2011 after the last bull market, 67%. And just measuring the same from where we are here today, 41%. So we're not as stretched as we are now, like we were in the last peak in 2011. Could still have definitely further to run. The market's showing it can do that in the past. And crude as well. Look at that on the monthly chart. And we'll just go down to a weekly here. Again, long consolidation has been floating with these lows of late. Just really kind of gridlocked market, crude oil, and could very well stay like that throughout this entire year. And just giving you a bit of a bird's eye view of global economic indicators. Looking at the world's 10 largest economies measured by GDP. States still in front, 27.3 trillion. China, 7.7 trillion. Like I said, their GDP growth still above 5%, just as India's. USA got the worst budget to GDP, 6.2%. Long term, it's been less than half of that. the last 4 years really got blown out. And that's why the States are only second to Japan in the percentage of government debt to GDP, 122%. But that's the problem for Japan right here, 0.5%. You can see how far below the rest of the world it is. They even somewhat normalized. They could bankrupt themselves from their interest expense to simply drowning in an ocean of debt. That's their real issue here. The other issue is Chinese inflation. They've actually been flirting with deflation. And so China pulling back and de-accelerating growth. Like I said, they're still really far away from a technical recession. You need negative GDP growth for that. Their disinflation over the last couple of years has likely helped global inflation a lot. What happens if their inflation goes back to 2-3%? That could really ignite global inflation, and that'll probably set off commodities, potentially across the board. And their industrial production is still strong, as is India's. Whose isn't is Europe, not to mention anemic growth. France, UK, and the EU, not even 1%. Germany actually going backwards. And in fact, I think the most recent quarterly print we got from France was a contraction as well. So definitely some growth issues for the UK and Europe, but that's why they've been dialing back their interest rates. Well, America, compared to most other developed nations, still quite big there. It's what's going to keep the dollar strong, as global investors can still do somewhat of a carry trade. Borrow at home, much more cheaper, and keep investing in the States for higher yields, not to mention way better growth and corporate earnings as well. And so it's a bit of a slow news day Friday, quite often get end of the week and the start of the week. So I thought I'd share with you guys just a few other interesting things. Again, it looks like Elon proving the haters wrong when it comes to his purchase of Twitter. We just heard X just reported to investors their adjusted EBITDA, 1.25 billion on revenue of 2.7. That's really incredible profit margin, even though revenue's come down a lot since 2021. As ever since Elon bought it, there's been a big push from certain people to encourage advertisers to pull their budgets from the platform, which a lot did. However, the company was just burning through cash, was never profitable while it was on the stock market when it came to cash flow. And no doubt he did overpay for it, 44 billion, but that was the cost to secure it. And I agree with Martin Shkreli. It could very well be worth 100 billion in the coming years, and who knows, may even come back onto the market as he's seeking to turn it into a super app. Another one for you today. One of the largest funds in the world, Norway, done an incredible job of investing the revenues from their fossil fuels into a massive pension fund. Actually works out to be more than $300,000 per citizen. Interesting to note, real estate only makes up 2% of the fund. Equities, the vast majority, 71%, and fixed income, 27%. And this has pretty much come out of nowhere over the past 25 years. And this is one of the smartest things a country can do. Norway pretty much owns a slice of the world now. And if they can protect that investment and continue growing it, their citizens will always be well off. It'll be interesting to see how the states do, as Trump's just initiated a new sovereign wealth fund. We also got the Super Bowl this Sunday night. Kansas City Chiefs versus the Philadelphia Eagles. Pretty much neck and neck here on Polymarket. The Chiefs are slight favorite, and looks like we are seeing huge amounts of bets on this massive event. Just here on Polymarket, 1.1 billion just on the market for who's going to win. And finally, this meme that popped up in my feed today. In the 80s and 90s, Al Bundy was considered fat and poor. Let that sink in. Those of you who don't know, popular TV show in the late 80s, going into the 90s, Married with Children. Al Bundy, the main character, was a woman's shoe salesman with a ditzy stay-at-home wife and troubled children, a depiction of the American middle class at that time. And like this meme suggests, he was considered fat, lazy, and poor. But how things have changed in the last 30 years, right? Be interesting to see where we are in another 30 years. But that's pretty much a wrap for the week, guys. Like I said, not a whole lot of big news out there today. Markets were off across the board, led by mega cap tech. Do have inflation coming next week, CPI. We're keeping an eye on these bond yields. Whether they break out again could put some more pressure on stocks. Otherwise, the VIX still seems quite chill here on a 16 handle. And looking underneath the hood, we still have a lot of dispersion. Some sectors not doing so well, some sectors holding up. The ones that are coming in the firing line for tariffs, copping another knock today, home builders. They import a lot of parts from overseas. Same with the retailers as well, bumping around here. But one of the best performing sectors, financials, still just sitting a couple of ticks below all-time highs actually. Whilst we've got discretionary stocks consolidating, and like I pointed out earlier, semiconductors especially. That's all for now. Have a great weekend, and I'll see you guys again come Monday night. Cheers.